Happy Friday, everyone. Welcome to our second episode of 2024. I am your host, Cassandra Collin, and this is Cass's Financial Outlook. Today, we will be covering a little bit in regards to tax strategies. We are going to cover tax deductions. So whether you are filing solely on your own, whether you're filing with somebody else, or whether you're filing for your business, we're going to cover different deductions that you can be using to save at the end of the year when you do your taxes. But as our normal disclaimers and normal disclosures, I am not a financial advisor. This is not financial advice. This is solely the outlook that I have in regards to these deductions. We're going to cover what I've used, what I haven't used, and then you're going to kind of explore on your own which ones will be best for you, depending on essentially how you're filing, because that does make a difference. So first thing first, let's cover a little bit more on what are tax deductions. So some people don't even know what tax deductions are, but pretty much tax deductions are what some people nowadays consider tax write-offs. And this is something that helps lower your taxable income, meaning that at the end of the year, the income that's left over is what's going to be taxed after those deductions. So you essentially subtract the amount, the tax deduction from your total income, and then that remaining balance is essentially what will be taxed at the end of the year. So it does help lower your tax bill, is kind of what these tax deductions do. So there's going to be about 20-ish different kinds of deductions that we're going to cover. So again, tax deductions is just a form to help cut back the taxes that are being applied to the income that you have. So at the end of the year, you have quote unquote a lower bill. There's some people who have credit, right? So we have tax deductions and tax credits. Credits are essentially money that you would be getting back. And once they calculate your deductions, then they give you your credit. So for example, if you owe $200 of taxes, but you have $1,000 in tax credit, then you will get $800 back, because first they take the cut. Of course, Uncle Sam's going to take his cut first, and then they're going to give you your quote-unquote credit that is for you. So that's a little bit on the difference between tax deductions and the tax credits. So the biggest thing that I want to cover right now is the child tax credit. So if you are not taking advantage of the child tax credit, this is basically a tax break for families with children that are below the age of 17. So if you have a child who's under the age of 17, you probably qualify for the child tax credit. In 2023, so this is the taxes that you're going to be filing this year in 2024, the child tax credit could get you up to $2,000 per child. And $1,600 of that credit is potentially going to be refundable. Okay, now for this one, you do have to be below a income threshold. If you are filing as an individual, it has to be below 200K in earnings for the year. If you're filing married as a couple, it has to be below 400K for the year. So that's how you qualify for the child tax credit. If you're under that income, you do qualify for it. So definitely talk with your CPA, your tax advisor, or whatever it is that you're using to see if you have the child tax credit available to you, which you should. Now, the second thing is child and dependent care credit. So not a lot of people know about this one, but this is short for CDCC. And this is meant to cover a percentage of daycare or any similar costs that you have for children under 13. It can cover up to 35% of $3,000 of the expenses. So the child and dependent care credit, again, it has to be a child under the age of 13. If it's a dependent, it can be a spouse or a parent who's unable to care for themselves. Now the third one, this is called the American Opportunity Tax Credit. The American Opportunity Tax Credit is sometimes abbreviated as AOC. It lets you claim up to $2,000 for the money that you spent on tuitions, books, equipment, school fees. You can't do living expenses or transportation. So if you're in school, you can actually claim and they're going to give you up to $2,000 in credit because of the American Opportunity Tax Credit. So you can also do an additional 25% of the next $2,000. So depending on how much you've spent on school, that's essentially how much they're going to give you back in credit. So it says the AOC lets you claim all of the first $2,000 you spent on tuition, books, equipment, and school fees. So pretty much if you spent over $2,000 in that category, you can claim that back, and you can do an additional 25% if you spent more than those $2,000. So a total of $2,500 could be given back to you because of the American Opportunity Tax Credit. So that's the third credit that you could get from your tax breaks. So the first three are credits that you can get back. The first one was a child tax credit, which we said you can get up to $2,000 per child. And then the second one was the child's independent care credit. And on this one, you can essentially claim up to 35% of the $3,000 that you've spent on child care or any dependent care. The third one is the American Opportunity Tax Credit. You can claim the first $2,000 that you spent on tuition, books, and equipments, and any school fees. And on top of that, you have the ability to claim an additional 25%, totaling to $2,500. Now, the next one is the Lifetime Learning Credit. So the Lifetime Learning Credit lets you claim 20% of the first $10,000 you pay towards tuition and fees for a maximum of $2,000. So it's kind of like the American Opportunity Tax Credit. The difference is that the Lifetime Learning Credit doesn't count towards the living expenses or transportation. You can claim books or supplies needed for like a coursework. So if you've taken courses throughout the years and it's totaled to more than $10,000, you can claim back the first $2,000 because they're letting you claim the first 20%. So they're a little bit similar when it comes to the life learning credit. So again, get with your CPA to see which one is going to be working best for you if you are in school or if you are taking any courses. Now, the fifth one, this is going to be a deduction. So this is the student loan interest deduction. And this lets borrowers write off up to $2,500 from their taxable income if they paid interest on their student loans. So if you've been paying off student loans and you've been paying off the student loans with interest, then you can claim up to $2,500. So you can write off or essentially deduct $2,500 from your taxable income because of the loans that you've been paying off with interest. Now, the sixth one, this is again a credit. This one is called the adoption credit. The adoption credit is a non-refundable tax break that helps taxpayers cover a certain amount of qualified adoption costs per child. So pretty much what this means is for 2023, so taxes that you will be filing this year, the max credit is going to be $15,950. So pretty much for anyone who adopted a child, it lets you max out your credit at $15,950. So depending on what the costs were for the adoption process, you can get credit back. So it obviously depends on income levels. And the income level here for the adoption credit, it maxes out, or essentially it phases out at $279,230. If you make that or more, that's where the credit essentially phases out. So if you make below that, the max that you can credit to yourself back is $15,950. So that's where it maxes out. So that's with the adoption credit. Again, the adoption credit is pretty much a non-refundable tax break that helps taxpayers cover certain amounts that are qualified. Whenever you are going through the adoption process for any of those costs, you can get credit back for that. So moving on, number 7. So this is the Earned Income Tax Credit. It's known for EITC, and this is also a refundable tax break. And this is essentially for low-income taxpayers, and it could be with and without children. For 2023, The tax credit ranges from $600 up to $7,430, and that's just really depending on how many kids you have, your marital status, and how much you made. So if you want to learn more details in regards to the earned income tax credit, you can go to nerdwallet.com and search up earned income tax credit, what it is and how to qualify, and it'll break down essentially how the income credit works. Now, the next deduction that you can write off in your taxes is a charitable donation. So if you donate anything to charity, whether that was cash or property, such as like clothes or cars, from your taxable income, you can actually deduct up to 60% of your adjusted gross income. That's a big percentage. So obviously you do have to show that you were able to donate that to charity, but anything that you donate can be considered a tax write-off. I actually used to donate at Catholic charities, and every time I would go to Catholic charities, they would give me a paper form that I could use for my taxes at the end of the year. I would take the stuff, they would ask me how much is it valued at. I told them the amounts, and then they wrote it down on a paper, and at the end of the year, I took it to my accountant, and we put it in my tax deductions. Now, number 9, some people don't know this, but medical expenses can be a deduction. So in general, you can write off qualified unreimbursed medical expenses that are more than 7.5% of your adjusted gross income for the tax year. So let's take that back. Let's say we make $50,000 for the year, right? And then we're going to multiply that times 7.5%. That means $3,750 of my adjusted gross income for the tax year. All right, so we're just going to keep it simple. Let's just say my gross is $50,000 and the 7.5% is a total of $3,750. So here for the medical expense deduction, if you have a medical expense that's unreimbursed and it totals to over $3,750, assuming you make $50,000 in gross income, it can qualify as a medical expense deduction. So for those of you guys who didn't know that, now you know medical expenses can be a tax write-off if they are over 7.5% of your gross income. Now, next one, deductions for state and local taxes. So obviously this is depending on the state. Now you may deduct up to $10,000. Now it's $5,000 if filing separate. So if you're married and you're filing separate, it's only $5,000. But for a combination of property taxes and either state and local income taxes or sales taxes, you can deduct up to a total of $10,000. But again, do your homework. Definitely dive deeper on property tax deductions, sales tax deductions, and how they work. Because again, it all depends on the state and the local taxes where you are located. Now, for those of you guys who have a home, mortgage interest deductions are also a way to lower tax bills. So the mortgage interest tax deduction is a way for home ownership to be quote unquote more affordable. It cuts the federal income tax that qualifying homeowners pay by reducing their taxable income by the amount of mortgage interest rates they've paid. So it's similar to how the student loan interest deduction. So it's similar to that one, but this is for your house. So if you are paying a interest on your home, you can essentially use that as a deduction as well. Now, this is for those who like to gamble. I'm not going to say that go and gamble. That's not what I'm saying. But for those of you guys who do gamble already and like to gamble, you can actually use that as a deduction too if you've had losses. So for gambling losses and expenses are deductible only to the extent of gambling winnings. So pretty much if you spend $100 on lottery, that is not a deductible. You cannot deduct that just because you spent $100. But unless you win and report it, then you can use that as a write-off. So you can't write off more than you win. So for example, let's say I spent $100, I won $200, but then I spent an additional $50. So pretty much I can write off what I've spent because I quote unquote won more than what I actually spent. So I won $200, but I spent $150 total. So that's what that means. You can't write off more than the amount you win. Next one, number 13, it says IRA contributions can be deductions as well. So the annual IRA contribution limit was $6,500 in 2023. And if you are 50 years or older, it was $7,500. Now, for 2024, the limit did increase. It went up to $7,000 for the year. And if you are 50 years or older, it went up to $8,000. So you can actually make contributions up to the tax filing deadline. So even though we're still in 2024 and you didn't max out your Roth from 2023, you can still contribute up to April 15th. And remember, for 2023, the total amount was $6,500 if you are below the age of 50 and $7,500 if you're over the age of 50. So 50 and above. Now, takeaways on IRAs is you can have multiple and you can contribute to multiple IRAs, but keep in mind that the annual limit is a combination between all your IRAs. So if you have a Roth and a traditional IRA account, the total amount that you can contribute to both of them combined is $6,500, and that is a tax deduction. Now, number 14, this is your 401k contribution deductions. Everyone's 401k is different because, for starters, not everyone uses the same company for 401ks, and the match for your company or your employer is obviously different too. Some people have matches, some people don't. So the IRS doesn't tax what you divert directly from your paycheck into a traditional 401k. So for example, in 2023, the contribution limit was $22,500. And if you are 50 years and older, it was $30,000. In 2024, the limit rose to $23,000. So pretty much they gave us an additional $500 that we could contribute to our 401ks. Same thing for those 50 and above, it changed to $30,500. Now, these retirement accounts are usually sponsored by employers. Now, self-employed people can also open up their own 401ks. If you didn't know, you can actually open up a solo 401k. So this is for your self-employed people that want to have some kind of retirement plan in place. You can open up a solo 401k. So number 15 is Savers Credit. So what is the Savers Credit? So the Savers Credit is essentially the retirement saving contributions credit, and it's called the Savers Credit for short, but it's pretty much a non-refundable tax credit that's worth up to $1,000 or $2,000 if you're married filing jointly, for mid and low income taxpayers who contribute to a retirement account. So the people who can claim the tax savers credit are those who are 18 and older, not full-time students, and are not claimed as independent on anybody else's tax return. So if you've been contributing to your retirement accounts, you could potentially be eligible for a tax credit that's up to $1,000. So again, get with your CPA on that and see if you qualify for it. Because if you have been contributing to your IRAs, your 401ks, your 403bs, or certain other retirement plans, you can qualify for this Savers Credit. Now, the next one is health savings account contribution deductions. So contributions made to your HSA are tax deductible, and the withdrawals are tax free. So pretty much if you are contributing to a HSA account, you are not getting taxed for that when you take it out, and it is also a tax deduction. So as long as you use them for qualified medical expenses, they can be tax deductible and withdrawn tax free. So that's a steal. Now, number 17 is the self-employment expenses deduction. So there are so many write-offs for freelancers and contractors and self-employed people. So for those of you guys who have a business, I can attach a link in the description below on how the self-employment tax deductions work or the expenses deductions work. So if those, you can have home office deductions, health insurance, mileage deduction, education. There's so many different things that you can use in your tax break when you are self-employed, but you have to do it strategically, because obviously you don't want to just write off every single thing that you purchase, because again, it's a balance. Now, the next one is home office deduction. If you use part of your home regularly and exclusively for business related activity, the IRS does let you write off certain items, and this is again for self-employed. So your rent, utilities, real estate taxes, any repairs, maintenance, or any of that stuff can be used as your home office deduction for those who are self-employed. Now, number 19, this is for your school teachers. This is the educator expenses deduction. So if you're a school teacher, you are able to deduct up to $300 spent on classroom supplies. So spouses who are both educators, if they're filing jointly, they can each write off up to $300 or deduct up to $300 on their tax return. Now, the last one is the solar tax credit. The solar tax credit is pretty much the residential clean energy credit, and you can get up to 30% of the installation costs of solar energy systems, and this can include solar water heaters or solar panels. So for those of you guys who have anything solar at home, you can put that in your deduction to get a tax credit, and you can get up to 30% of the installed cost. So whatever the installation cost was, you can deduct up to 30% and get a credit back. Now, this is a bonus. Since electrical vehicles have become a new norm, you can get a EV tax credit, which is your electrical vehicle tax credit, and it ranges from $3,750 to $7,500 for the 2023 tax year. So you can get a credit of up to $4,000 for used cars, and then the eligibility depends on pretty much all these different rules, including income, the price of vehicle, whether the car meets the IRS manufacturing guidelines for a electric vehicle. So these are essentially the 20 different tax deductions and tax breaks that you can use when you are filing. And as mentioned, tax deductions are there to help you lower your tax bill. So yes, taxes are not fun at the end of the year to deal with, but if you play the game and you're ahead of the game, you don't have to stress about it when the time does come, because again, you can keep track of these things throughout the year. And remember, the tax credit and the tax deductions are different. Credits are things that you're essentially getting back, and deductions are things that you are just putting in your taxes to make your gross income or your taxable income lower. So if there are any questions in regards to tax breaks and tax deductions and how to maneuver these things, you can definitely reach out. But again, we're learning together, so keep that in mind. Definitely reach out to a certified professional accountant, so your CPAs, or anyone that is using TurboTax. Definitely read through their guidelines, their fine prints, whatever it is on there that's going to help you file your taxes appropriately, because you don't want to get audited. If you do get audited, then that means you have to show that everything that you put in there as like your tax credits and your tax deductions, you have to show proof that you do qualify for those. So just make sure that you are using these to your advantage, but also using them in a form that does qualify to you. So again, that was tax deductions and tax breaks for 2023 and 2024. And again, this is Cassandra Collin with Cass's Financial Outlook. Thank you for tuning in on episode number 7. We will see you at our next podcast. And again, don't forget to like and subscribe on our YouTube channel. We have our visuals there for a reason. We are on Spotify, Spreaker, Apple Podcasts, anything you can essentially think of that's audio, we are probably on. Don't forget to leave us a review. If you do have any questions or if you have any topics that you would like for us to cover in the next couple of weeks, then definitely leave them in the comments below. If you are listening to Spotify, Apple, or any other podcast platform, please leave us a review, 5-star preferred. But again, we definitely want genuine and honest feedback. We want to make sure what's helping, what's not. So again, this was Cassandra with Cass's Financial Outlook, and we will see you on our next podcast. Have a great day.